Good morning, students. Welcome back to our session on capital gain. Today is our concluding session where we will be covering all the remaining topics that are left out from this chapter. Plus, we will be completing the sums which I had given for practice that I'm sure once you solve them, you will get a clear picture of how capital gain computation happens. One thing is for sure, you would have realized this, that capital gain is a topic which consumes the least time while solving. It is not requiring more than 2 minutes to solve because there are no technical calculations involved. There is no format. Format means working notes like salary chapter involved. The format is also not very lengthy like salary and PGBP. So that way, capital gain is the most scoring topic. The only point in capital gain, which is very crucial, is recalling the correct provisions. And that is where regular study, regular revision, and continuous practice is very, very, very important. So let me start. If anybody has any particular question, any doubts, let me know. We have completed major part of your theory and your provisions part. Now we are on the solving part. And today, after completing the solving, which was the homework, I'll take you to the remaining provisions, which deals with the section 54 exemptions and also how tax is computed. Though tax computation is a separate allotted topic where you will be dealing with computation of tax exclusively. But here at least we will study the provisions so that when you go to that practical topic of tax computation, you are aware of the provisions. So let me start. Yes, very good morning. Navneet, Neeraj, Pranav, Shraddha, Thiyasumi, Dhanalakshmi. Very, very, very good morning to you all. So, where were we in practical? How many questions were done? We did, I think, 4 questions. So we have to solve from 5 onwards today. Okay, first let me take queries. I have questions. Okay, Pranav is asking me, sir, is the forfeited advance a deductible expenses from the PGBP income? So first, let us understand. See, whenever you are understanding tax provision, you have to be clear about the nature of transaction and the persons involved. So in the case of advance, so let us say I am the owner of this property. Now I am proposing to sell it to you. You are the buyer and we agree to a price. You seek 6 months time. I say, okay, fine. Give me some advance and token. So you give me 25 lakhs as token today. And later on, for some reason, you do not turn up or you wish to cancel this transaction. So I forfeit this 25 lakhs advance. This is what is the basic point. Now in this, I am the receiver of this advance. Now for me, this advance is what? This advance is treated as my income. Now pay attention, students, to what I'm going to say, because taking this question which is asked, I'm going to expand the point further. So we studied till now that this advance forfeited will be taxed under the head other sources if this advance is forfeited after 1st of April 2014. So if I'm forfeiting the advance today, definitely it falls in this new provision, which is after 1st of April 2014. Now, interestingly, there is one more point that this particular advance if forfeited before 1st April 14, the tax treatment was different. The tax treatment was that this advance would not be treated as income upfront. Rather, it would be deducted from the cost of acquisition of this asset. Fine. Now coming to your side. So this was tax treatment of the recipient side. Now we have the tax treatment on the payer side. Now for you, what is this payment? Now again, it is important that why you are buying this and in what capacity you are buying this. If you are also going to buy this as a capital asset and this negotiation fail and I forfeit your advance, the tax treatment in your hands is nothing. In other words, you cannot claim this as any expense or deduction under any PGBP. What is your particular question? Why? Because see, the simple rule is under PGBP, what is allowed? Four golden rules. It should be related to business, current year, revenue, not an offense. Now, when you are making payment for this building, firstly, is this related to business? It may not be. But still, the third condition is not satisfied. The third condition was it should be revenue in nature. If you are planning to acquire a capital asset, definitely it is not a revenue payment. You will not get deduction under PGBP. Now, but there is a second angle to this. The second angle is what if you are dealer in properties and you are buying this property as a stock in trade? Now the answer will change. If you are proposing to buy this property as a stock in trade, then this is no more a capital item for you. It is a stock in trade, so it is a revenue item. Now, whatever advance you have paid to me, which I forfeited, will now become your PGBP expense. So, beta, this is how the answer will come. So, only directly concluding is not important. You have to first understand in what capacity this transaction is entered into by you. So, this advance forfeited by me, which is my income, will be a deductible expenses for you under the head PGBP if you were buying this property as a stock in trade of your business. Otherwise not. Fine. Perfect. So let us proceed to our sums. Mrs. Pari sold jewelry on 15th August for 72 lakhs. She had received the jewelry from her mother under a will. Now this is going to be interesting on this date. And the mother had purchased it on this date for this amount. Now here, what is sold is jewelry, which is a capital asset. Sale is transfer, and there is no exemption under 10 applicable to this transaction. Section 10 exemption is only for one transaction, that is under 1037, where agricultural land is compulsorily acquired and you are a farmer. Other than that, there is no exemption under 10 as applicable to your cases. Now, in this particular case, this is a taxable transaction. Now, when jewelry is sold, when you are doing computation, what is full value? Now, see, if you remember, I had made my summary, which I'll be sharing with you all today after the class. See, so in this summary, I have made or given the whole computation format with some important inputs. Now, what is the summary here? What you are selling is gold, silver, bullion, jewelry, archaeological collection, drawings, paintings, sculptures, work of art, or unlisted shares. For all these assets, long term will be after 24 months. Remarks: Only for unlisted shares, there is something special relating to full value of consideration. For unlisted shares, the full value of consideration is higher of the sale price or your FMV. But here, what we are selling is not unlisted shares. What we are selling is gold or jewelry. Now, for this gold or jewelry, as far as full value, expenses on transfer, cost of acquisition, cost of improvement, there is no specific provision when it comes to gold or jewelry. So, for this, normal provisions will apply for full value. And normal provision says what is full value? It is the amount which you receive against the asset. So full value is clear. Now we come to the other part, expenses on transfer, nothing is given. Then we come to the next part, that is cost of acquisition improvement. Now here comes the second special point. What is that special second point? You received the asset. How? In one of the ways which is not regarded as transfer. What is that? Will. If you remember, in the very first class, which was even revised later in next two classes, we discussed what is transfer, what is not transfer. And in the concept of transfer, we discussed that whenever there is gift, will, inheritance, these are not regarded as transfer. Now, in this particular case, whenever the asset is transferred by way of gift or will, it is not regarded as transfer. Now, if you remember, I had given you the first golden rule. What was that golden rule? That whenever you receive an asset by one of those mediums which is not regarded as transfer, then for you, the period of holding will be counted from previous owner to decide your long-term, short-term. Plus, for you, the cost of acquisition is also cost of previous owner. This is what we studied in section 49.1. So firstly, for deciding long-term, short-term, your period will be counted from the date of previous owner. So from here till your date of transfer, one day before the date of transfer, you will count the period of holding. And similarly, how to decide cost of acquisition? Section 49.1 says cost is cost of previous owner. So here for you, yes, correct, Shamli. The cost is 25 lakhs, which is the cost of previous owner, and the full value is 72 lakhs. Now, cost of acquisition, you have the special provision, which is under 49.1, where your cost is cost of previous owner. And again, this is a long-term capital asset. Is this fine, students? Is this clear to all? Anybody, any questions or doubts in this? Perfect. $47 lakhs is your long-term capital gain. Correct? Good. Next. Mr. Adani sold Goodwill of his business to Mr. Ambani on this date for 5 CR. Now, what is this? This is intangible asset. So goodwill, trademark, copyright, LUMARS, all these are intangible assets. Again, it is an asset. Yes. Sale is a transfer. Yes. So it is a taxable transaction. Now, what is the special point when it comes to intangible assets? So for intangible assets, the special point is, see, firstly, period of holding rule 24 months applies. Baki year of chargeability, year of transfer, full value is regular. What is special is the cost of acquisition. What is special in cost of acquisition? In cost of acquisition, the rule is if your asset is self-generated, the cost is nil. But if you have purchased that intangible asset, then cost is your actual cost. So the special provision is cost of acquisition for self-generated asset is nil, and for actually purchased asset is the actual cost. Most important, cost of improvement will always be nil for self-generated assets. So this is the only special point when it comes to intangible asset. So here, full value will be our normal provisions because there is nothing special for full value. For cost, the rule is it is the price at which you have actually purchased. So Mr. Adani had purchased this goodwill from Mr. Aziz Premji. So this will be the cost of acquisition. Correct? So it is 5 crores. And here the cost of acquisition as per section 55 is the actual cost of purchase, which is 50 lakhs. Right? I was expecting this question. So I've got that question, which is a pain of every student. Sir, whether writing section number in the sum is compulsory. See, students understand this. Capital gain carries the least 6 marks. It is always 6, 8, 10. It means capital gain is having decent weightage. But as you can see, what is the format? It is having the most simplest format. Then where the marks, 6 marks or 8 marks will come from? It will come not only by solving, it will come mainly by writing the provisions. So you have to give your explanatory provision for everything. For full value, if there is nothing, firstly you say that this asset is a capital asset, first line. So below this you will be writing notes that jewelry is a capital asset, this is a capital asset, this is a capital asset. In some case you will write that since this is not a capital asset, hence there is no capital gain. Since this is not a transfer, hence there is no capital gain. If it is asset and transfer, like see how I'm explaining, you have to write in the same fashion. Sale of jewelry is liable to capital gain because jewelry is capital asset and sale is transfer. Point number one. Point number two, full value. There is no special provision for full value in case of jewelry. Hence, the general rule given under section 48 applies. Full value is the amount received. Third, expenses on transfer, no special rule. Section 48 applies. 4. Cost of acquisition. Now here if there is a special rule, you say since the asset is acquired from the previous owner by way of gift, will, inheritance, which was not transferred, hence as per section 49(1), cost of acquisition is cost of previous owner. Or you will write like in this case, in case of intangible assets which is purchased, cost of acquisition as per section 55 is price at which it is purchased. In the next question, it will come that the goodwill is self-generated. So we'll write in case of intangible asset which is self-generated, cost of acquisition is nil. Is this clear, students? Now, actually, this section is not only 55, it is much further, 55 something, something, something. So if you are able to recall everything, that's great. If not, still, I will request that at least you write the main section. So let me show you. See, I've already kept things open so that I can show you how the provisions are. So this is your section, main section for cost of acquisition 55, where 55 subsection 1B is for cost of improvement. Right now we are on cost of acquisition. So see 55 subsection 2A, it deals with what? In relation to capital asset being goodwill of business, profession, etc., etc. So it is talking about intangible assets first. In case of acquisition of such asset by the assessee by purchase from a previous owner, it means the amount of purchase. This is what is applicable to us right now. So if I have to write it completely, then my section number will be 55 to A1. Why? Because I have purchased it. In my next question, the answer will be 55 to A3. What is 2A3? In any other case, it shall be taken as nil. And when it is nil, when it is either not purchased by you, nor it is belonging to the previous owner case. What is 55A2? In cases falling under 1 to 5 of subsection 1 of 49. So this is where you have received the asset in such a manner which is not transferred. So what is your cost? It means the cost of previous owner. So this is our rule of 49.1, even covered for intangible assets. And last is where it is not purchased, then the cost of acquisition will be nil. So if you can write everything, subsection, clause, subclause, best. But at least the main section, subsection should be written. So answering your question, Hina, and to everyone, please learn section numbers. I know it sounds slightly heavy. It may sound slightly difficult. It may sound unmanageable. But let me tell you, with regular practice, with regular revision, you will be able to do it. How I remember section numbers, every time when I talk about the sections or if I solve that particular question, I write the section number, or when I'm talking, I mention the section number. Initially, I look and talk about the section number. I read and talk about the section number. Over a period, many sections start coming automatically. So that is what I'm saying. Keep revising, keep studying. The more you are revising with sections, you will automatically remember and recall the sections. And yes, you should write it. So this is the Bear Act coming back. What would be your answer if Mr. Adani had created the goodwill? So it is self-generated. Now here what will apply? If Mr. Adani had not purchased it from someone but had himself created the goodwill and now he is selling the goodwill, the answer is, we just saw, cost of acquisition will be nil. So the answer will be completely same because everything is same, the asset is same, all other things are same except for one point, that now this is nil. 55 to A3. So here long-term capital gain is complete 5 crores. Perfect. Very good. Students, I'm sure you all also would have got the same answers. And most importantly, now you are also understanding the flow. So this is how you will be solving any question on capital gain. Correct? Kuldeep is saying section 55. Okay. So what do you want to say, Kuldeep? 55? What? Next, Mr. Kapil Dev sold his bungalow on this date for 2 CR. And now comes this special point. If you remember our previous class, we discussed the sections relating to full value. Now, the general rule for full value is what is amount received. This is the general rule. And then you have some special cases for full value, in which the most important case is section 50C. If you remember, you have studied this even in PGBP. And while explaining in the last class, I had explained it along with the PGBP section, because both ways the section are same. Kuldeep will not use bracket. It is not 50 clause C, it is section 50C. So you will write 50 and next to 50 you will write capital C. You will not write it in bracket. Now, what does 50C of capital gain and 43CA of PGBP says? That whenever any land or building is sold, Here, bungalow is sold, so it is immovable property, it is building. So whenever any land or building is sold, if it is stock in trade because you are a dealer in that, the answer is in PGBP, but the answer will be same what we are discussing here, and over there section is 43C. But here you're not in the business, so this is a capital asset. It is sold, so it is transfer. Now for this, the full value is computed by comparing your sale value with stamp value. Now what is 50C and 43A saying? If your sale value is higher, then you don't have to look at any other value. Your sale value will be the answer. But if stamp value is higher, then you will not take the stamp value directly. What you will do is, now you will compare your stamp value and your sale value by making the sale value 110%. Now, what is this 110%? It is 2.2 crores. Now you'll compare this 110% value with your stamp value. Now, what could be the possibility? This 110% value is higher than the stamp duty value. If this would have been the possibility, then the answer would have again been 2 crores. That is your original sale value. But here, this is also not the possibility. Here, what is the possibility? That my 110% value is still smaller and the stamp duty value is still greater. Now, since the stamp duty value is still greater, so my final answer is the stamp duty value. This will be my FBC under 50C. Now, this is the first part. Now, in this, there is a second part. If your stamp duty value is higher, but and it is higher means it is even higher by that 110%. So eventually you have to take that stamp duty value as the full value. But you believe it is exorbitantly high, it is incorrect. Then the law has given you an option that you can refer your case to the valuation officer. Now, if you refer your case to the valuation officer and the valuation officer finds out a value, we call it as the valuation officer's value. Now, what does the provision says? Once you have found out the valuation officer's value, compare the value with stamp value. Again, two possibilities. If valuation officer's value is even higher than the stamp value, then your final answer will be stamp value. But in the present case, valuation officer's value is lower. So whenever the case is referred to valuation officer, the final answer will be lower of the stamp value and the valuation officer's value. Now, in this present case, the valuations officer value is lower. So your final answer will be 2.09 crores. This is what is 50C of capital gain and 43CA of PGBP saying. I hope you all remember. I hope you all understand. Navneet, wait, we'll come to cost. I'm proceeding one by one. So in this sum, I have given you the complete 50C in one example. All aspects of 50C are covered in this one sum itself. So I hope everybody understood that how I reach to the final answer, that is full value under 50C will be 2.09 crores. Right? Again, year of chargeability is the year of transfer. Now here the answer is, and this is, now see here I'm writing 50C. You'll have to explain this as a note because this sum will carry minimum 6 marks and maximum 10 marks. Right? Now comes the second part of this question. So sorry, let me check if there is any expenses given. I've not checked that. Commission is given, so that will be deducted. So my net sale consideration is 2 crore 4 lakhs after deducting the expenses on transfer, which is the agent's commission. Now you come to cost of acquisition. Now again for cost of acquisition, if there is no special effect, then the cost is as per section 55(2), it is your cost. But here again, what is given? You purchased the bungalow in 1983. Now here you have purchased the asset before 2001. And for assets which are purchased before 2001, again, there is a special provision. What is the special provision? The special provision is that where asset is purchased before 2001, you have to compare your cost with the FMV on 1st April 2001. And you have to take whichever is higher. That is your cost or FMV on 1st April 2001, whichever is higher. However, in this, again, there is a small twist that if the asset is land or building, then you will not directly compare with FMV. You will first compare the FMV of 1st April 2001 with stamp duty value also of 1st April 2001. And between these two values, you have to take whichever is lower between the FMV and the stamp duty value. You have to take whichever is lower. So what is lower here? 55 lakhs. And this lower value is compared with your actual cost and you take whichever is higher. So my final answer is 55 lakhs. I'll just show you in our provisions, which I'll be sharing with you. So see, firstly, land building. If you are selling land building, period of holding is 24 months. In this, only one thing is exempt. That is, if it is rural agriculture land, there will be no tax. And for full value, the special provision is 50C, which we just discussed. So this is what is special point whenever land building is sold. Remaining everything is as per the other regular provisions. Now coming to the second point. What is the second point? Second point is about cost of acquisition. And here the asset is acquired before 1st April 2001. Need that box. Asset acquired before 1st April 2001. Yes. Now, where asset is acquired before 1st April 2001, period of holding is as per the nature of asset. Here, the asset is land building. So we know what is the period of holding. It is 24 months. Now, what is important? What is the rule? Cost of acquisition. If it is for any other asset, it is higher of directly actual cost and FMV of 1st April 2001. But if it is land building, then it is higher of your cost. But this cost is compared with what? Lower of FMV and stamp duty value on 1st April 2000. So you have to first take lower of FMV and stamp duty value. That lower amount is compared with your actual cost and you have to take whichever is higher. This is again as per section 55 2B1. If the asset is purchased by you and if it is the previous owner case, then it is 55 2B2. So ours is our own case. So section is 55 2B1 and the asset is purchased by you before 2001. So as per 55 2B1, what is your cost? You compare firstly FMV and stamp duty value, take whichever is lower, and this amount is compared with your actual cost. You take whichever is higher. So your final answer is 55 lakhs. Right, students? So this one sum covers two important aspects. One is full value in case of land building. And second is, what if this land building is acquired before 1st April 2001? So what will be the cost of acquisition? So both special provisions, 50C and 55 2B1, both are covered in this one question at one place. Now, there is something special relating to land building. We need to understand and discuss that also. What is that? So for land building, period of holding 24 months. If it is rural agriculture land, there is no capital gain because it is not asset. Year of chargeability is year of transfer, no problem. Full value 50C is okay. What is interesting is right now we are computing capital gain. While computing capital gain, there is no indexation done. But when in future you will be computing the final tax liability, then there is an option of indexation. This option of indexation is given to whom? It is given only if you are a resident individual or a resident HUF. If you are a resident individual or resident HUF, and what is the asset? It is long-term land building. So our case is long-term land building only. Then if this asset was acquired before 23rd of July 2024 and sold after that, then you are given this option of doing indexation. Now, what is this option? Section 112 says you will compare two tax amounts. One is calculate tax at the rate of 12.5% by taking the amount without indexation, which is the present amount. So what we have calculated right now, 1 crore 49 lakhs is our capital gain without indexation. This is the final computation. So as far as capital gain calculation is concerned, this is final. This won't change. This you are going to consider in your total income computation. You will make all the computation final. Only when you are computing tax in the working note, you will make two calculations. One, you will calculate 12.5% of this 1 crore 49 lakhs. Second computation is you will do another computation, which is with indexation. Now here in this question, even though we are not computing tax, but I want to show you this option so that your entire understanding of this is clear. So let us say you have done your total computation. So the sum is on computation of income. You have different heads income here. So salary, let us say you have 12 lakh 50,000 final income after all deductions and all. HP is 5 lakhs. Let us say PGBP is nothing. Capital gain is this LTCG, this amount which you have found out by working note. Generally, in all the computation of income, all these things, salary calculation, HP calculation, whatever we have been studying in various chapters, all this will be part of working note. So what we are studying right now also is part of working note because main calculation is the main computation of income. So here I'm writing 1 crore 49 lakhs. Let us say in other sources you have dividends 2 lakhs. So this is your GTI, right? From this, you have deductions under chapter 6A. Now, when you'll study further chapter 6A deductions, you'll realize that there are two schemes for computing tax that you already know, the present, the new scheme, which is also the default regime, and the old regime. If you are in the default regime, 99% of deductions are not available, and I'm going by that regime only. So you reach TI. TI is what? TI is your taxable income. So firstly, how much it is? 49 plus 2, 51, 51 plus 5, 56, 56 and 12 is 68. So 1 crore 68 lakhs 50,000 and 1 crore 68 lakhs 50,000. So I've reached the taxable income. Now I'm computing tax. Now this is where this 112 option comes. So when you are computing tax, so again, this is a working note, computation of tax. Now, whenever you are computing tax on 1 crore 6850, you will study this that for tax computation, there are two categories. One is regular income and you have special incomes. In special, what is covered? All long terms are covered. Short term under section 111A is covered. Winnings is covered. So there are few incomes which has a special tax rate. So we call it as special. All other incomes like salary, HP, PGBP, then from other sources, majority of the other sources income, these are regular. Now for these regular incomes, you have the slab rate. So out of this 168, my special income is this capital gain long term, which I'm having 149. And other than this, all other incomes are my regular incomes. So other than this, how much is my income? 12, 5, 17 to 19. So 1950, which comprises of salary, HP, PGBP, other sources. All this is my regular income. On this, you apply the slab rate. Now for this, you have to compute tax. What is this? This is my long-term capital gain on sale of land or building. Now, when you are doing this computation, this is as per section 112. It deals with what? Tax on long-term capital gains. Now for this, if I am resident individual HUF first, plus the asset is a long-term land or building, then I am given option. What is this option? One is without indexation. Now, without indexation, I'll compute tax at the rate of 12.5% multiplied by 1 crore 49 lakh. That is the capital gain which we have computed, which is without indexation. Second option is with indexation. So here the tax is at the rate of 20%. Now for this, I'll have to do working with indexation. So I'm showing that working here. So if this same question is solved, so I'm writing A dash just to say that it is the same question solved by the second approach. So this FVC remains same, expenses remain same, net consideration remains same. Now cost of acquisition is also same. The only thing is that I'll have to index this cost. So my cost is 55 lakhs. How do I index? I had explained this in the class when we were discussing the indexation part. Just we go to that indexation table. If you remember, I'd explain you the logic of indexation. So let me today show you the practical working. Yes, now see, these are the indexation rates. So we call it as the indexation table or the indexation rates. Now, these rates are starting from 2001, 2002. You do not have the indexation rates for period prior to 2001-2, and that is where the provision which we just discussed, that is if the asset is of a period before 2001-2, you take the FMV of 2001-2. Why? Because you do not have the past period indexation rates. So we bring the value up to 2001-2 by taking the fair market value of 2001-2, or in this case the stamp duty value, so that now your cost has reached up to 2001-2. And from 2001 to till date, you index using this cost inflation index. Now for 2001-2, which is the base year, the index is 100. And for the current year, when you have transferred the asset, the index is 376. So how do I index? I multiplied by the current year. And since this value which I have taken is of 2001, I divided by the base year, that is 2001's indexation rate. So how much is my amount after indexation? Yes, very good, Navneet, very good, Shamli. So it is, see, the value has inflated. Now you are getting the value as 2 crore 6 lakhs 80,000. This is the value which I've got. Correct? This is what is indexation. Kamlesh beta, indexation applies for long-term assets. However, from last year, that is from 23rd of July 2024, the law has stopped indexation. So now there is no indexation. You see, we have already solved 8 sums. In all 8 sums, all assets are long-term. I have not indexed in any case. However, only for this one case, What is this one case? You are individual resident in India or you are HUF resident in India, and the asset which you have sold is long-term land or building. You are given an option, and this is what I'm showing you. But let me tell you again, while doing computation, capital gain will be computed always by only one method, that is without indexation. But when you will be doing final computation and finding out tax, at the time of computing tax, only at the time of computing tax, you will apply this option. What is the option? Compute two taxes. One is on the original capital gain which you have computed without indexation, the tax will come at 12.5% of the amount. Second is, now do one more parallel working where you are going to index the cost, which is I'm showing you. So here I have indexed the cost. Now after indexing, the cost has inflated. This is what is the meaning of indexation. You are inflating the cost for the inflation effect. That is what is indexation. Now, for the first time, in all these examples, I have got a long-term capital loss. Now, interestingly, here when I'm doing comparison, this tax is nil, and here there is some amount. I think Shamli gave me that amount also. Shamli has given me as 186.25. So 1862 was tax if you are taking the original capital gain, which is without indexation, and with indexation, the tax is coming as nil. So now obviously I'll opt for this. So here the tax which I'm computing on this will be nil. On my other incomes, which are regular incomes, I'll compute tax at the slab rate, whatever is applicable to you. Just for simplicity to complete the answer, I'm assuming that this tax is coming as 2 lakhs. So tax on regular income is coming as 2 lakhs, and tax on this capital gain. Now, interestingly, capital gain is computed without indexation, but the tax which I have taken here is with indexation because that is coming lower. So my final tax liability will be this 2 lakhs of regular income, nil of long-term capital gain. So my final tax liability will be. So only when you are computing the tax, you will be checking the indexation option. For whom? For resident, individual resident HF who have sold a long-term land building. Only when both these conditions are satisfied, only at the time of tax computation, you will check the option of with and without indexation. And in the tax, you will select the amount which is lower tax. So importantly, the capital gain still remains of without indexation amount. So capital gain amount will not change. In your computation, capital gain amount will remain of 1 crore 49 lakhs, which is of without indexation. And the tax is whichever is lower. So it is tax off with indexation because it is lower. I hope students, you all understood this point. Perfect. Good. So this is the point about indexation. This is the point about capital gain on building or land. And this is how tax computation is done. So with one example, we have covered so many aspects of taxation. Students, if anybody has any questions, please feel free to ask. Yes, now you'll never mix indexation provisions. That is why, see, since last two lectures, many of you all were giving some inputs, ki sir, like I think you only, Neeraj, wanted practical sums. Somebody else was talking about some future provisions, but I was trying to resist every one of you all. Why? Because had I tried to explain it at that time, it would have been a lot confusing. So I waited. I came to the right point when you know the provisions. And now when you are solving, you get clarity of everything that we discussed, that we studied. Kuldeep is saying so indexation can be applied after calculating taxable income. See again, Kuldeep, indexation is applied only in working note. Please remember this. Which working note? Working note of tax calculation. Now, when tax calculation will come? When you are doing the total computation. Now, in exam questions, you will get sums only on calculating PGBP, only on calculating salary, only on calculating capital gain. Like here, we are doing only calculation of capital gain in this chapter. So when you're doing only calculation of capital gain, there is no indexation. But when you will do sums on total computation, computation of total income with deduction, with set off, over there, when you will reach the amount of tax. So even here in capital gain figure, you will always write the figure which is without indexation, because now indexation has been removed. Keep this in mind. Indexation has gone. So in all your computation up to total income, the capital gain will always be without indexation. Only when you are coming to the final point of your computation, which is tax. So here in the working note of tax computation, if it is a long-term capital gain, which is of land building and the assessee is the resident individual or resident HUF, only in the tax computation you will show this option of without indexation tax, with indexation tax. And for that, you will have to do one more working. So wherever you have done working of capital gain, make one more working, which is with indexation. But this will be done only for computation of tax, not beyond that. Perfect, students. Good. No, Navneet, it is not necessary that indexation is always beneficial. In this example, you are getting a tax which is lower when indexation is done. Maybe in some other examples, when we will continue this process, you will find that, because see why? Because indexation is having a higher tax of 20% and without indexation is having a lower tax of 12.5%. So that is a very big difference. So you cannot conclude that indexation will always be beneficial. Had that been the case, why would have they called it as an option? They would have simply said that in this case, you take the tax of indexation. That is not the case. Navneet, correct. In this example, that is how it is. Only in this example, it is beneficial. Yes, Dhanalakshmi. So while computing tax, you compare the tax, which is for with indexation and without indexation both. And in both, whichever is lower, like in this example, the tax where indexation was done is lower, so we took that tax. Maybe in some other example, the tax where without indexation tax is lower, we'll take that example. We'll take that option. But again, I repeat, students, in your computation, that is when you are solving the sum and finding out capital gain, and when you are finding out your final taxable income, till this point, up to this point, there is no question of indexation anywhere. So till you have reached your taxable income, you will not even think of indexation. You have to think of indexation only when the point comes of computing tax. For computing income, for doing set off, for doing anything up to TI, there is no question of indexation. Fine, students. I hope everything is now crystal clear. What people have given, I don't remember. Who's CV? Good. Let us proceed. Now in this sum, I've added one more aspect, which is improvement. So till now, we were not having cost of improvement. In this question, I've added that aspect as well. Now, Amir Khan is selling his commercial property. Commercial property is capital asset, sale is transfer, so the transaction is taxable. It is sold on this date for 5 CR. Now, students keep in mind, once it is a land or building, full value will always be calculated by 50C. That is after comparing with stamp value and everything. But many times it will happen like in this question, they have not given you any details of stamp value and all. In such cases, we are still applying 50C. But since other details are not there of stamp value and valuation officer's value, etc., we are assuming that 5 crore is the final answer. Why I'm telling you this? Point is, you have to always remember that whenever the asset sold is land or building, always 50C is attracted. But if the details of 50C related details are not given in the question, then we will take the value which is the sale value and assuming that it is as per 50C only. That is, whatever 50C says, the final answer is 5 crores. So 9 sum. Now, what else is given? He had purchased the asset. Now, again, the same point has come. The asset is purchased before 2001. So you have to apply the rule of FMV of 2001. Plus, since this is land building, you have to also check stamp duty value of 2001. So here they are. So FMV of 2001 is 2 crore. Now, again, interestingly, students, stamp duty value of 2001 is not given. Now, if it is not given, now our rule is we have to take out of both whichever is lower. If it is not given, you assume this is lower. And now you'll compare this value with your purchase cost and take whichever is higher. So finally, my cost of acquisition is 2 crores. So after applying all the provisions, my cost of acquisition as per this same section comes to 2 crores, right? Now the main point of this question is cost of improvement. Now for cost of improvement, you are given improvements which are done in different years. And see, this is a capital asset. So you may have done capital expenditure on this multiple times. Now comes the main point, which is our main point of interest in this, because this is the new adjustment I've added, that you have done improvement first in 96, 97, then 7, 8, and then 1920. Now, if you remember, we had discussed two special points about improvement. Yes, very good, Navneet, very good, Shamli. First special point about improvement that we studied was that if it is intangible asset, improvement will always be ignored. Point number one. And point number two, improvement done before 2001 will also be ignored. No, Kuldeep, improvement of previous owner is to be considered. That will come to that type of sum also where your asset has come from previous owner by gift will and you are taking cost of acquisition of previous owner, you will also take improvement of previous owner. There is no problem with improvement of previous owner. In improvement, only in two cases improvement is not taken. One, where it is intangible asset, improvement of intangible asset is not taken. Two, where improvement is done by anyone, whether by you or by your previous owner, but it is done before 2001. So in this, we will ignore this improvement and we will only be considering the other two improvement, that is 30 and 75. So here it will be 1 crore 5 lakhs. And we will deduct both this and I will get my final answer. Now again, students, for your reference, whenever you will come to computation of tax, again, the asset is long-term land building. Again, the assessee is resident individual. So again, for this asset also, you will have two calculations of tax. One is of this amount which we have done, which is without indexation, and the other is of the amount with indexation. Let me show you the working. So when you'll come to tax computation of this, now one, you will index this. Two, you will also index this. Now this is going to be interesting. I'm just showing this working here. Indexation of question number 9 bar. First is of computing index cost of acquisition. Now, what is my cost of acquisition? It is 2 crores into current year rate. We had just calculated it here. Current year indexation rate is 376 and this cost is of 2001. So it is divided by 100. Now, interesting is index cost of improvement. Now, we have taken two different improvements. What are those two different improvements? Of 7.8, which is 30 lakhs, and of 1920, which is 75 lakhs. This is 30 lakhs. Now, both these improvements will be indexed. How? Multiply by the current year rate and divided by their respective year's rates. So we need rate for 7.8. 7.8 rate is 129. So I will take 129 here. Now we need rate of 1920, 289. So 289. So this is how you will index all these values. But again, students, let me repeat, all this working will not be required in this chapter. This chapter means when your question is only on computation of capital gain, no need of doing the second working of indexation. All this working will be done when you are in the chapter of computation of final total income and tax. And in exam, generally you have only first question which deals with computation of tax. All other questions generally are only computation of income. So over there, please remember, don't do the other working which is with indexation. Correct? So this is how you'll find out index cost of improvement and index cost of acquisition. Lingar 145 is not correct. I hope you understood why. Because beta 9697 index, 9697, which is the date before 2001, we don't consider cost of improvement. No, there is a logic also why this provision is there. If I have to give you the logic, see, there is logic behind every provision. If you understand logic, understanding the provision is easy. Now, what is the logic? Why they have made such a provision that you will ignore improvement done before 2001? The answer lies in the provision of 2001. Now, what is the provision of 2001? That you have to take cost of acquisition of 2001, which you take as the FMV stamp duty value, comparing with your actual cost, whichever is higher. Now, if you're taking the FMV of 2001 and that becomes your cost of acquisition, so automatically all improvements up to 2001 is included in your FMV or stamp duty value of 2001. So in your cost of acquisition, what we are taking as the cost? We are taking as our 1st April 2001's FMV or stamp duty value, right? We took in both these sums in 8 and 9, the same thing has happened. We have taken the cost as per this provision. What is the cost? If the asset is before 2001, you find out the value on 1st April 2001, which is the FMV, compare it with the stamp duty value, whichever is lower, and compare that value with your actual cost, whichever is higher. Now, since you have taken the stamp duty value or FMV of 2001, till that date improvement is done, it means in this value, which is of 2001, improvement cost is already covered. Please understand this. I'll explain it like this. You purchased the original building in 1996, which was of 2 floors. Oh, sorry, you purchased it before that of 2 floors. Then in 1996, you carried out improvement. What was that improvement? You constructed the 3rd floor. So that is what is the improvement in 96, 97. Now, importantly, when you come to 2001 and how you are finding out your cost of acquisition by taking your actual cost and comparing it with 2001's value of that building. Now, on 1st April 2001, that building is having 3 floors. So when you have computed the stamp duty value or the fair market value of that building, it is of 3 floors, which is including the 3rd floor, which is the improvement. So your cost of acquisition itself is of 3 floors. So it means cost of acquisition itself is including the 3rd floor, which is the improvement. So you cannot take it separately in improvement. This is the logic. That is why the rule is made that you ignore any improvement done before 2001. Students, is this clear to all? The logic of why improvement before 2001 has to be ignored. So that is a provision, you're right. But at the same time, it has a reason. See, and provisions, 90% of them have some logical backing. Yes, 10% of them may not have a backing, logical backing. It may be a policy decision. But 90% are logical. If you understand the logic, remembering, applying is easy. Correct? So here you will take the index cost of acquisition, you will take the index cost of improvement, and you'll get the final answer, which you will be using for computing the second tax, and then comparing both the tax, whichever is lower will be your answer. Correct, students? So I'm sure by now all are clear with the capital gain calculation relating to land building. First, the full value is as per 50C. Second, the cost of acquisition. If it is previous owner, if it is before 2001, you have to take the relevant provisions. And generally, in case of land building, this will happen. You have to take 2001 provision because the cost is before 2001, or it is a building which is inherited under will, etc. So it becomes the previous owner case. And after all this, you find cost of acquisition. You will not index the cost of acquisition. You will find out capital gain directly. That is how your capital gain will be computed always. But if the question also involves tax computation, then only in the working note of calculation of tax. In that, for this land building, you'll do one more working, which is with indexation. And for both the capital gain, one is without, which is in the original working, and one is with, which is only working note, you'll find out tax. Without indexation, tax is 12.5%. With indexation, tax is 20%. Compare both the taxes, whichever is lower is what you have to pay. So this is the special point relating to land and building. And this is what I have even given in my this summary. So in this, for land and building, period of holding you apply. There are two rules of period of holding, 12 and 24. For land and building is to 24. Another important point about land building is if it is rural agriculture land, you would not do any calculation because it is not a capital asset, so no capital gain. Year of chargeability is regular. Most important full value is 50C, and second important point is indexation, but only done at the time of computation of tax. Clear, students? Crystal clear? So I have tried to make this revisionary chart for you all in this fashion that when you are solving sums, your sums will be falling within one of these categories, so that applying it will be easy. And this also helps you in doing fast revision, and there will be least chances of mistake because I've taken all the provisions related to that particular aspect at one place, right? Let us proceed. Smriti Irani sold the work of art. Now we all know work of art, even if it is kept in your house as a decorative piece, even if it is for personal use, we studied earlier that still it is a capital asset. The general rule is personal effects are not capital asset, but there is exception. Jewelry, even though personal is capital asset, and paintings, drawings, work of art, sculptures, all these, even though for personal use, that is for decorating your house, is still a capital asset. So this is the capital asset. It is sold. So there is transfer. It is liable to capital gain. Now, what is the full value? In full value, there is no special provision. So full value is your actual cost. What is the cost of acquisition? Again, there is no special provision for work of art. So cost of acquisition will be as per normal provisions. Now here, what is the case? She had purchased it in 2006. So this is after 2001. So 2001 rule, you don't need to check. So your actual cost of purchase is 40. However, what is special is in 2010-11, she had tried to sell this work of art, but that transaction did not materialize. However, at that time, she had received some advance, which was also forfeited by her. Now, for this advance forfeited, you have to do what? You have to check the period. If the advance is forfeited before 1st April 2014, the rule is different. If it is forfeited after 1st April 14, the rule is different. Here it is forfeited before 1st April 2014. So what is the rule? The rule is if it is forfeited before 1st April 2014, then the amount forfeited has to be reduced from your cost of acquisition. So for advances forfeited before 1st April 2014, the rule is the amount is deducted from the cost of acquisition and you calculate the new cost of acquisition, right? See, I'll just show you my other, uh, yes. And last time I had asked you all to take screenshots. You all have taken different, the screenshots into three parts. Now here in cost of acquisition, this provision is important. Where is the provision? Advance forfeited. We did not write it here. Okay, I think we only discussed. I have not written it here. So we have only discussed it from our module. It is not written here. Okay. Okay. So if the advance is forfeited before 1st April 2014, then the law says you have to subtract the cost of acquisition, the advance forfeited from the cost of acquisition, and that will be your new cost of acquisition. See. Did we study? Yes. This was in fact the last one, so hence I missed writing it. So advance is forfeited before 1st April 14. What is the rule? While computing capital gain, what you have to do? Advance forfeited has to be deducted from what? From your cost of acquisition. So that we are going to do here. So there is an advance against a capital asset which is received and forfeited. What is the rule? If it is done before 1st April 2014, you find out your new cost of acquisition, which is cost of acquisition minus advance forfeited. If it is 1st April 14 onwards, then no change in cost of acquisition, and this advance forfeited is directly shown as your income from other sources. So the date is very important. In our present question, the advance is forfeited before this 1st April 14 date. So what we are going to do, we are going to reduce it from the cost of acquisition. So I've sold it for 1 crore. There is nothing special in full value. There is nothing special in cost except for this advance forfeited point. So 1 crore is my full value of consideration now. As per section 51, what I have to do? I have to take my actual cost of acquisition, which is 40 lakhs. From that, I subtract the advance forfeited. So it is 40 lakhs minus 35,000. So my new cost of acquisition is 39 lakhs 65,000. Correct? So 60 lakhs 35,000 is my long-term capital gain. Correct, Navneet? So my capital gain is 60/35. Clear, students? Student, just give me 2 minutes, please. So this is the working wherever advance is forfeited. But students, you have to remember, if this advance was forfeited after 1st April 14, I would have not changed my cost of acquisition. So in my capital gain calculation, the cost of acquisition would have been the same, that is 40 lakhs. And then this 35,000 would have been directly shown as my other sources income. This is what is the difference of tax treatment. Yes, correct. No need. Let us proceed. Now, next is Alia Bhatt has sold her unlisted shares. Now, the moment unlisted share comes, you have to remember that there is a full value provision under 50 CA. What it says that for unlisted shares, the full value is higher of your sale value and the fair market value. So you will take higher of this. This is what is the special provision relating to unlisted shares. So section 50 CA, 81 lakhs, correct? What else is given? Brokerage was 3 lakhs. Now here, keep in mind, there is one very special provision relating to expenses on transfer. We have been deducting all expenses on transfer, but there is one exception where expenses on transfer is not deducted. That will come when we will have listed shares. Because when you are selling listed shares through stock exchange, the stock exchange deducts STT, securities transaction tax. That is the only item which is expense on transfer but not deductible. So that you will see when we go to the sums relating to listed shares. Okay, fine. Now, so this is up to full value. Now, what is further given? She received the share under the will of her father. Now, this is 49.1 that whenever the asset is received under any mode which is not transfer, like gift, will, inheritance, holding, subsidiary, 49.1 says your cost is cost of previous owner. So here, the cost of acquisition under 49.1 for Alia will be her father's cost. Now, she has received the shares under will on this date. Now, interestingly, father has acquired the asset before 2001. So if father has acquired the asset before 2001, what will be the cost of acquisition of father as per section 59.2, which we studied earlier? It will be the actual cost or FMV on 2001, whichever is higher. So the cost of acquisition of father is whichever is higher, and that becomes your cost of acquisition. Correct? Now, this is as per which section? So this is as per C. Where capital asset became property of the assessee before 1st April 2001, it means the cost of acquisition or fair market value, whichever is higher. They are saying at the option of the assessee, so it is whichever is higher. Now, interestingly, where the capital asset became property of the assessee by any of the modes specified in 49.1. What are these modes? These are the non-transfer modes. Asset is acquired by give, will, inheritance, holding, subsidiary, etc. And the capital asset became the property of the previous owner also before 2001. So this is our present case. What is your cost? Your cost is cost of previous owner. And what is previous owner's cost? Which is as per this section. So what is the cost of acquisition? It is the cost of acquisition of previous owner or FMV, whichever is higher. So what are we applying? We are applying section 55, subsection 2, clause B, subclause 2. Subsection 2B2. Correct. See, you may not even go up to the subclause, but at least 55 to B, this much you should remember. So as per this, my final answer of cost of acquisition is 10 lakhs. Correct? Okay. 12. Mrs. Twinkle Khanna had purchased shares for 30 lakhs in a listed company. Listed, give me some time. We'll do it after a break because this requires a whole different application. Let me first complete the other questions, which are now easy for us. So Shakuntala purchased land in 1994. So your purchase is before 2001, so you know what is to be done. Take FMV of 2001, compare it with stamp duty value of 2001, take whichever is lower. Now out of this, what is lower is 75 lakhs. Compare it with your purchase cost, out of this whichever is higher. So final cost of acquisition is 75 lakhs. Same as per section 55 2B, which we just saw. Now, she has sold this asset. Now, since this is immobile property, for full value, section 50C applies. What does 50C says? You have to take the sale value, compare it with stamp value. Now, if stamp value is higher, you have to take 110%. How much 110% comes? It comes to 3.3 crores. Now compare this 110% with stamp value. You have to now check if the stamp value is still higher. So your final answer as per 50C will be stamp value. Correct? Now you have another option that where stamp value is high and that becomes your full value, you can go to valuation officer. And now you take the value of valuation officer and the stamp value and take whichever is lower. So here it is finally the stamp value, which is the answer. So now I'm just doing working here. So FVC finally as per 50C is your stamp value, which is 3.5 crores. Cost of acquisition finally is 75 lakhs. And your final LTCG will be 2.75 lakhs. Now again, since this is a land, you are a resident individual. At the time of tax computation, you will do two workings. This is without indexation, where the tax will be 12.5%. You will do one more working, which is with indexation, where the tax will be 20%. Next, Mumtaz sold paintings and sculptures. This may be personal because it may be used for decoration of your house, but still it will be treated as a capital asset. Now this, she has I'll just correct this. It should be 2025. So she has sold it on 7th of November 2025 for rupees 85 lakhs. I have purposefully given you FMP. Now see, it is not necessary that only the relevant provisions will be given. Now some irrelevant provision is also given. What? You have sold painting and sculptures. Sale price is 85 and FMV is also given. Now please remember, whenever you are finding full value of consideration, FVC, FMV or your sale price, whichever is higher, this rule applies only for unlisted shares. Other than unlisted shares, you will never take whichever is higher as your full value. This is only a deceiving point given in the question. So your full value will not be taken as FMV. Correct? Now you purchase it in 98, that is before 2001. So again, 2001 rule applies. You will take whichever is higher. So your cost of acquisition is 45. And again, your long-term capital gains 40. Correct? Again, this share part, I'll leave for a minute. Next, Mr. Avinash received as gift on this date from Mr. Mahesh. Mr. Mahesh had purchased the asset on this date. Now see, whenever you receive asset by way of gift, this is going to be interesting. Now when you receive asset by way of gift, gift is not transfer. So for you, what is the rule? Your cost is cost of previous owner as per 49(1), correct? But now, in case of gift, there is something different. In case of gift, you have other sources, which we'll be studying after capital gain. In other sources, gifts are made taxable if they are received from unrelated persons exceeding 50,000. Now, this is where the law changes. 1 second, there are many points in the, okay. Now, students pay attention. This is slightly confusing at a time, but if you pay attention, it will be easy to understand. Now, what is the rule? The rule is whenever you acquire asset in one of the modes which is not transfer, like I've written here. If you acquire the gifts in one of the modes which is not transfer, your cost is cost of previous owner. So we have this one provision, which is our golden rule. What is the golden rule? That wherever you acquire the asset by one of the modes which is not transfer, your cost is cost of previous owner. Correct? However, now there are conflicting provisions. For what? For asset which is received as gift. Now, gift is also one of the modes which is not transfer. So at the same time, two different provisions are applicable for gift. One, our golden rule one, that is your cost is cost of previous owner. But at the same time, there is another rule which is applicable for gift. What is that rule? Now, if at the time of receiving the gift, if this gift was taxed under 56(2), I have given you this as golden rule 3. What is golden rule 3? Whenever at the time of receiving any asset, that asset was taxed, then the value which was taxed will be taken as your cost of acquisition. Now, if the gift is taxed, I'm using the word if. So if the gift is taxed under 56(2), you will apply this rule. What is your cost of acquisition? Cost of acquisition is the amount which is taxed. But if at the time of receiving gift, it was not taxed, then for you, cost is as per golden rule 1, cost is cost of previous owner. This I will explain with this example. This example is specially crafted for this. So you have received gift and the previous owner's cost is given. Now you sell this gifted item in the current year. Now what is important for full value? There is no special provision. Full value is as per normal provisions. So your full value is the sale price. Now in 12, there are two possibilities. Gift not taxed, gift taxed under other sources at the time of receipt. Now, you have sold this gifted asset for what price today? Today you have sold it for 1.2 crores. Now, full value is same. Expenses not given. So till this point, there is no difference if you are selling a gifted asset. Now, the difference is here. Cost of acquisition. First is our golden rule 1, which says cost is cost of previous owner. When this will apply, if when you receive the gifts, you did not pay any tax. So for you, the cost is cost of previous owner. But if when you receive the gift and you had to pay tax at the time of receiving the gift, then our golden rule 3 applies. And as per golden rule 3, whatever was taxed at the time of receipt, that will be now treated as cost. So for gift, there are two possibilities in cost of acquisition. Golden rule 1, golden rule 3, that depends upon whether at the time of receiving gift it was taxed or not taxed. Now in this example, what I have written, in compute capital gain is the gift was received from a related person. That is both Mr. Avinash and Mahesh are related persons. Now we'll study in other sources that if you're receiving gift from related persons, it is not taxed. So it means here gift was not taxed on receipt. If it was not taxed on receipt, then for you, as per golden rule 1, cost is cost of previous owner. So in this case, I apply golden rule 1, my cost is cost of previous owner. But in second possibility, where they are not relatives and the gift was taxed, where taxed? Under other sources, as per section 56 bracket 2 clause 10, then whatever amount was treated as income for the purpose of making that calculation under other sources, that amount which was income over there will be cost over here. So in this second part, your cost of acquisition will be 45 lakhs. So see, same question, everything same. Only what changed, whether at the time of receiving gift, was it taxed or not taxed. If not taxed, cost is previous owner's cost because gift is not transferred. If taxed, since it is already taxed, you will take the amount which was taxed as your cost of acquisition. So here 95 lakhs, but here it is 75 lakhs. Students, is this point clear? Navneet, it is not nil. If it is from relative, you apply a previous owner rule. Your cost is cost of previous owner, which we did even in previous sums, where building was received from father as gift. Over there, it was directly written father, mother, something. So you already knew that it was not taxed. Here, I have only written names, not said that whether they are father, mother. So, because I wanted to create two possibilities, that is why I created two possibilities. What if the person who's gifting is your father, mother, that is a related person? Then it becomes the same old rule, cost is cost of previous owner. But if they are not your relatives, it means at the time of receiving gift, you were liable to get taxed under capital gains, under other sources. So now the second rule applies, which is your cost is price, which was tax, which was considered as your income under other sources. Perfect, students. See, all possibilities, all types of calculations are done in these examples. Right? Perfect. So we'll take a break, 15 minutes, and then we'll come and deal with the remaining sums and the remaining provisions. Fine, students? Let's take a break. Chalo. Let us go to remaining sums and the remaining provisions. STCG always tax. No, Mustafa. STCG is not taxed at 20%, beta. LTCG with indexation 20%, LTCG without indexation 12.5%. And this option also is only limited if the asset is land building, if the asset is resident individual HF, if the asset was acquired before 23rd July, 24th July 24 and sold after that. Only after all these conditions are there, then long term has two options. If any of these conditions are not satisfied, long term also has one option. So Mustafa beta will come to short term. If you remember in the last class, I had said now two things are left. One is exemption under 54 and one is tax rates that we'll do today. So why you are in always haste? I can teach everything at one go, but that should be digestible. Na? So let us go step by step. We are proceeding. Na? Now you all have consolidated this point. We'll go to short term. We'll go to tax rate. Fine. Allow me some time. Aditya beta, now how can you ask me when 20% can be taken? We already discussed this in multiple sums, and I just repeated it for Mustafa that whenever you are taking the long-term capital gain with indexation, in that case only the tax rate of long-term is 20%, which is an option subject to conditions. Let us proceed. Now, Mr. Mohan sold his motor car, and this motor car is a personal motor car. Now, students, there would be sums like this, which appears to be a capital gain computation sum, but here no computation is required because the car is not a capital asset. Since it is not a capital asset, there is no capital gain attracted under the charging section. So for such questions, your answer will be simple and straightforward. You'll answer it saying that since personal motor car is not a capital asset, hence the transfer of personal motor car will not result in a capital gain under 45(1). Clear? Next. Mr. Akshay sold some archaeological collections. Again, these may be used by him in his house for decoration. These may be his personal use item, but these personal assets are also capital gain liable to tax because they are capital asset. Now, he sold them on 9th October for 80 lakhs. Expenses on transfer in 3 lakhs. So first, FPC, there is nothing special. So it is as per regular provisions. That is the price which is received, which is 80 lakhs minus expenses on transfer 3 lakhs. Net consideration 77 lakhs. Now, he had purchased it in 2018 for 60 lakhs. Okay. Again, here the advance forfeited category is included. The advance was forfeited. One second. I should change this. So let us say the date of purchase was 2012. Now, for this asset, he had tried to sell this asset earlier, and at the time of negotiation, he had received some advance which was forfeited. He forfeited rupees 3 lakhs on 8/2/2014. What is the tax treatment? And the question is tweaked. What will be your answer if the advance is forfeited on this date? Now, if I have to answer both, in first case, where advance was forfeited on 8th of Feb 14, what will be the answer? The cost will be actual cost minus advance forfeited. So it will be, that is LTCG 20 lakhs. But in the second case, FVC 80 lakhs. Expenses on transfer. Now, in the second part, where the advance is forfeited on 15th of March 2015, now cost of acquisition will be your actual cost only. There will be no change because now the advance is forfeited after 1st April 14. And if it is forfeited after 1st April 14, this advance forfeited will be treated as your income from other sources of the previous year 14-15, and it will not be adjusted from your cost of acquisition. So here the answer is this. So see, this is the difference depending upon when advance is forfeited. Correct. Yes, Navneet. The only difference is in this question, I just added both the elements so that from the same question, you will get the feel of both the possibilities if advance forfeited before 1st April 14 and after 14. Next, Mr. Mukesh has a residential property which is purchased in 12-13 for 40 lakhs. It was destroyed by fire. Now, this is one special case where asset is destroyed by fire. Now, please pay attention to this. Important point is wherever an asset is destroyed by fire, technically, there is no capital gain arising in that transaction. I repeat, whenever capital asset is destroyed by fire, technically there is no capital gain arising in that situation. Why? Because capital gain arises whenever asset is transferred. Now, if your asset is destroyed, it is not a transfer. Destruction of asset cannot be a transfer. Now here, let me inform you students, up till the year 2001, if I'm not wrong, maybe yes, if I'm right, there is a judgment of Mother India Refrigeration of Honorable Supreme Court, which said that in case of destruction of asset, there is no transfer, there is no capital gain arising under the charging section 45(1). Now, because of this decision, whatever insurance claim money was being received, it was not being taxed. To overcome this, the law amended and a new parallel charging section was introduced only for the insurance cases under 45(1). Now, what does this charging section say under 45(1)(a)? It says that whenever you are selling, not selling, sorry, whenever there is a destruction of any capital asset, and why it has or how it has got destructed, maybe because of flood, typhoon, hurricane, cyclone, earthquake. So let us call it as natural calamities. One, or because of some riots, civil disturbance. Now, of late, you all have seen this in Bangladesh, in Nepal, in so many places. So you know what is a riot or a civil disturbance. So at that time, people, they destroy properties, they put things on fire, they rampage some assets, they dismantle it. Many things are done. So if your asset is also destroyed because of this, or there is some accidental fire, or there is some accidental explosion, or if there is any action by an enemy, maybe with or without war. We even know this very recently. We had experienced this when we carried out Operation Sindoor. We were having retaliation action by them, and maybe certain drones which were fired by Pakistan may have actually landed on some person's house, on some person's shop, or on some person's car, and it may have got destroyed. So wherever there is action by an enemy, or we are taking a counter action against an enemy, and in that process also any of your asset is destroyed. So where your asset gets destroyed in any one of these cases, firstly, this is not a transfer. So it is not fitting in your main charging section 45(1). Then where it gets fit, you have this new parallel charging section in the form of 45(1)(a). And this charging section says it will be now taxed in a new manner in a special charging section 45(1)(a). And what is the new manner? It will be deemed to be your income. Why the word deemed is required? Because actually it is not your income. Why actually it is not your income? Because there is no transfer, so there is no 45(1) applicable. However, it is taxed specially by deeming it as the income. And what is the special point? It will be taxed in which year? It is not taxed in the year of destruction. It is taxed in the year when you receive the insurance claim. What will be the full value? It will be the amount of claim received. So, what is special in case of destruction of asset? Again, in my short notes also have covered this. Asset destroyed by fire. Period of holding will be as per nature of asset, but generally it will be 24 months. What is special point? The special point is it is a parallel charging section. Charging section. Section 45(1). What is special? It says year of chargeability is year of receipt of the claim. Full value is the claim amount received, or if any other asset is given, the FMV. Other things are regular provisions, whatever are applicable. So coming back to our example. So asset was destroyed in 24-25, importantly. So it is destroyed in the last year. However, you receive claim in the current year. So we will bring it to tax in the current year as per section 45(1)(a). What is the question number? 17, 18. So here, what is important is we are taxing it in the current year, though destruction took place in the last year, and this is as per the parallel charging section or a separate charging section 45(1). Full value is simple. It is the claim received. Cost of acquisition is as per regular provision. Asset was purchased in 12-13. So 2001 rule is not required. Previous owner rule is not required. So it is your actual cost. See, calculation is not changing. What is important is this technical point, that it is not transfer. Hence, your regular charging section is not applicable. This is the only point you have to keep in mind. Is this clear, students? Yes, Shraddha. All these will be covered: terrorist attack, bomb blast, etc. Right, students? So this is about the parallel charging section 45(1)(a). Next. Sorry, this was 19, not 18. This was 19. Next. Mr. Munna acquired property for ₹20 lakhs in Jan 2014. Okay. On 15th August 17, he started a business of dealing in the property, and this property was treated as a stock in trade. Now, this is again a special case, which is conversion of capital asset into stock in trade. Now, what is special, students? See again. If you originally have a capital asset, so original what you had is a capital asset, but later on you decided to start doing business of that same asset. That is, you are now going to use that asset not for using it in business, but for trading it and earning profit. That is, you treat it as stock in trade. Now, whenever you treat an asset as stock in trade, the law says we will deem this as transfer. If you remember in the transfer definition, this was one of the cases where converting your capital asset into stock in trade means, converting means in balance sheet it was appearing at the top in fixed asset. Now it is appearing in the bottom in current assets. By changing this classification, it will be treated as a transfer. Capital gain will be attracted. For this, you have a special provision, section 45(2). What it says, the interesting point is, you have converted it in some past year, but the year of chargeability is the year of sale. So it won't be taxed in the year in which you converted. That year there is a capital gain, but it will be taxed not in that year, but in the current year when you have actually sold that stock in trade. Interestingly, again, the special point is what will be the full value? The full value will be the fair market value on the date of its conversion. So the date when you convert it, that will be the date for deciding the fair market value. So I'll explain this with the help of this example. So what has happened in this? You had originally purchased the property in January 14 for 20 lakhs. Then in August 17, you decided to change your line of business. And this same property, which was still now your capital asset, is now treated as stock in trade. So this land or this property is now shown in your books as stock in trade. Why? Because you have started a new business of dealing in properties. Now in this year, as per the definition of transfer, there is a transfer. What is the transfer? You have converted the status. Now this is 1718. Now in 1718, you converted the asset, but you don't have to pay any tax. Why? Because the tax will not be paid in the year of conversion. It will be the paid when this stock in trade is finally sold. Now when it is sold today in the current year. Now, when you are selling it in the current year, interestingly, there is another income which is arising, which is PGBP. Because what you are selling today is a stock in trade, and sale of stock in trade, it becomes PGBP. So, in this example, there are two incomes applicable. One is your PGBP, which is for sale of this asset, which is now your stock in trade. And the other one is capital gain, which is for conversion of original asset. Now, how do you find out PGBP? It is sale price minus cost. Simply, this is PGBP. How do you find out capital gain? It is FVC minus. Now, interestingly, here I am writing ICOA. Why? I'll tell you. Now, firstly, what is the full value? This section says, for the purpose of taxing this special transaction of conversion, the full value will be fair market value on the date of conversion. So, what is the fair market value? It is 59 lakhs. So fair market value is the value on the date of your conversion. Just slight correction, it is 15th August. So fair market value is the value on the date of its conversion. This becomes your full value of consideration. Now, what is the cost? Cost is the regular provision. It is price at which you had purchased. It is 20 lakhs. Now, interestingly, I have written over here index cost. Why? Because even though you are doing the working today, but actually this capital gain is of previous year 1718 because conversion had taken place in that year itself. In that year, indexation was applicable. So here you are going to compute capital gain by actually indexing this. So what is your cost of acquisition? It is 20 lakhs acquired in January 14. So January 14 means your financial year is 1314. So remember, you have converted it in 1718 and your purchase year is 1314. Now, how do you index? You multiply it by the year of transfer and divide it by the year of purchase. So we have to take indexation rates of 1718 in the numerator and 1314 in the denominator. Hmm. So 1718 is 272. So numerator is the year of transfer. Denominator is the year of purchase, which is 1314. What is the indexation rate of 1314? It is 220. So indexation rate is 220. So you index this and you get your long-term capital gain. Correct? Yes. So give me the index cost. 2 lakhs, sorry, 20 lakhs multiplied by 272 divided by 220. Okay, Navneet is saying 24,772. Okay. Acha, 727, not 772, it is 727. 24. So now this difference is my long-term capital gain, which is 34, 27, 300. Now, what will be my PGBP income? Now for PGBP, I'll have to see the sale price, that is the price at which I've sold the asset. Today I'm selling it for 72 lakhs. So 72 lakhs becomes my sale price. Now, interestingly, what is cost? Please understand, you converted the capital asset to stock in trade. And for this conversion, you took the full value as 59. So automatically for your stock in trade, the amount which was considered as full value in capital gain will become cost in stock in trade. So this 59 is your cost for the purpose of PGBP, because in PGBP, the stock in trade has come at this value. Correct? So your PGBP is 13 lakhs. Correct, students? Perfect. Perfect. Very good. Uh, Manish ji, somebody is asking for the WhatsApp group link. Can you please post it? Correct. So student, this is how conversion of capital asset into stock in trade is to be dealt with. Right? Great. Now let me take one more example. I did not find it in module, but since that point is also there, let me add it over here. That is compulsory acquisition. Now let us say you have purchased a plot of land in the year 1516. For what price? For rupees 20 lakhs. Now this plot you had purchased as an investment. However, central government decided to take over this plot because the government was constructing a 6-lane highway from there. So central government compulsorily acquired your plot. When it acquired on 14 Feb 2022, this plot was acquired and the compensation was fixed as rupees 1 crore. Interestingly, in 22, when this compulsory acquisition happened, they did not pay you this compensation. It was paid how? 24, 25, they paid 75 lakhs. And in 25, 26, they paid balance 25 lakhs. So this compensation was paid to you in two parts. Now, this is first part of the story, that you had purchased a land, the land was compulsorily acquired by government, and you were paid the compensation in two parts. Now, interestingly, what is the interesting point? The interesting point is you were not satisfied with this 1 crore. You felt that this is very less. So you had filed a suit against amount of compensation. So I'll just write assessee had filed suit against the amount of compensation. Now, High Court ordered the compensation to be rupees 1.85 crores. So High Court increased the compensation. Your legal fees for fighting the case was rupees 20 lakhs. And now important, pay attention. This enhanced compensation. Enhanced means the increased portion. How much is enhanced? Original was 1 crore and court said it should be 1.85. So this enhanced compensation of rupees 85 lakhs was paid to you in the year 26-27. So this is an example of compulsory acquisition. Yes, Kuldeep, you're right. Now, for this compulsory acquisition, again, student, just take a screenshot of this. So you'll have the figures, the dates with you handy. Right, Shamli? Now, how to deal with the case of compulsory acquisition. Now, for compulsory acquisition, the law has made a special section 45(5). Firstly, compulsory acquisition is regarded as transfer. We saw this in the definition of transfer. Now, in this, there will be two parts. First part is your original compensation. Now, what does 45(5) says? Year of chargeability is the year of receipt. So, when will I be taxed? I will be taxed in the year when I have received. Now, when I have received, I received this compensation, first installment in 24-25. So the law says we will tax it in the year when you receive the first installment. What will be full value? Full value is the amount of compensation fixed minus why index cost of acquisition? Because again, this transaction is of the earlier period, only it is getting taxed later. Earlier period indexation was applicable. So what is the cost? 20 lakhs. Purchase year is 15-16. Transfer year is 21-22. So I have to divide it by 15-16 year index rate and multiply it by 21-22 index rate. So 20 lakhs multiplied by 21-22 index rate, which is the year of transfer. That is the year when the government acquired it. So it is 317 divided by the year of purchase. What was the year of purchase? It is 15-16. So what is the indexation rate of 15-16? It is 254. Correct? So 254. This is my capital gain loss, whatever, on original compensation. Students, please let me know the final amount. Shraddha says it is 24,96,063. Okay, thank you. 24,96,063. So my capital gain on the original compensation. Okay, Shamli has confirmed this. 24,96,063. So my capital gain on the original is this. Correct? But then later on, Honorable High Court expanded this compensation amount. So I got extra also. Again, when this extra will be taxable, it will be taxable in the year of receipt. When am I receiving it? In 26-27. So now what will be my full value? Full value will be the extra amount because already 1 crore is taxed. Honorable High Court has increased it to 185. So now I'm receiving the extra, which is called as enhanced compensation, which will now be taxed. Correct? Now, interestingly, what is my expenses on transfer? I spent amount in fighting the case. So the legal fees, which is 20 lakhs in this case, is my expenses on transfer. And now what will be my cost or index cost of acquisition? Answer is it is nil. Why nil? Because I have considered entire cost at the time of original computation. For enhanced, there is no cost left because entire cost I deducted in my original computation. So while doing computation of enhanced, there will be no cost of acquisition that is deductible. Is this clear? Right, students? Could we proceed? Is this clear to all? Now we come to one more special case. What is that special case? Now, for long-term capital gain, students, we have two sections for computing tax, or I should say computing capital gain and tax. One is 112, which we saw earlier also, and the other is section 112A. Now, what is 112A dealing with? Firstly, what is 112? It deals with other capital assets. Other means other than what is covered in 112A. 112A deals with what? It deals with listed shares or units of equity. Now, if you are selling listed shares or units of equity oriented fund, section 112A applies. Now we saw already what is 112 saying. We have now whatever calculations we did, students, till now is as per 112 only, because till now we did not have listed shares. But now we will do the calculation for listed shares or units of equity oriented fund, both listed. Now, what is important to be noted is if you have listed shares or listed equity fund units, which are units of equity oriented fund, then there is a special provision in the law. What does this provision in the law says? One second. What is the special provision? Yeah, I'll write it here. Section 112A. Now, what is 112A saying? So, whenever you have listed equity shares or units of equity oriented fund, section 112A is attracted. Now, what is 112A saying? Let me take you to the provisions. See, tax on long-term capital gain, section 112, which we discussed till now, and 112A. Now, what is 112A dealing with? 112A says that the tax rate for the capital gain covered under 112A will be 12.5%. See, it was different up to last year. Last year, from 23rd of July, there are a lot many amendments. This is also amended. And interestingly, this 12.5% will be applicable on long-term capital gain exceeding 1,25,000. So you can say up to 1,25,000 is exempt. So this is a special exemption for 112A long-term capital gain, that up to 1,25,000 amount of long-term capital gain is exempt, and for remaining the tax rate is 12.5%. Now when this applies, you have transfer equity shares, units of business trust, units of equity oriented fund. Most important, the most important condition is that these are listed, and at the time of transfer and purchase both, if it is equity shares, both at the time of transfer and at the time of purchase, STT was paid, both purchase and transfer. And if it is units of fund, then STT should have been paid at least at the time of transfer. Now, when both these conditions are satisfied, what? The asset is equity shares or asset is units of equity oriented fund, and second, STT has been paid, then comes the computation. What is this computation saying? See, students, there is no special format. Computation is same. It is FVC, which is your sale price. Now, since these are listed shares, you will not compare it with FMV. We studied to compare with FMV, but that rule was applicable to unlisted shares. These are listed shares. So FVC sale price minus expenses on transfer. Now, since these are listed, STT would be paid, but this is not allowed as deduction. We have studied this. So this is very important. No deduction. So entire sale price becomes your net consideration. Now, what is important over here is cost of acquisition. Now in cost, what is the possibility? The possibility is shares acquired after 1st Feb 18 or shares acquired before 1st Feb 18. Now, if shares are acquired after 1st Feb 18, what is cost? Cost is your actual purchase price. No problem. But if these shares were acquired before 1st Feb 18, now the scenario changes. Yes, Navneet, correct. STT, CTT is allowed only in PGVP, not in capital gains. Correct, beta. Now, what is special, students? If the shares were purchased before 2018, what does the law says? The law says, again, you have to compare three values. One is your actual cost of acquisition. Second is your FMV on 31st Jan 18. That is just before 1st Feb. But this FMV has to be first compared with your full value of consideration. That is this price, the price at which you are selling it, that is sale price. So first is you have to take out of both these value, whichever is less. So FMV on 31st Jan 18 compared with full value of consideration, that is sale price, whichever is less. And then between these two values, you have to take, see, this is like the same 2001 rule for land and building. You take actual cost, compare it with what? Lower of two values. Lower of which two values? FMV on 1st April 2001, stamp duty value on 1st April 2001. Out of both, whichever is lower, that is compared with your actual cost, whichever is higher. Same rule applies over here. You take FMV on 31st Jan 18, compare it with your sale price. Out of both, whichever is lower. And this lower amount is compared with your actual cost of purchase. Out of both, whichever is higher. This is your cost of acquisition. And then finally, after deducting this, you will get long-term capital gain. Let us say this long-term capital gain comes as 240. Now, when you are computing tax on this LTCG, which is under section 112A, what it says, this 240 will not be fully taxable. You will have a exemption of 125. So on this balance 115, your tax will be at the rate of 12.5%. This is what is the special provision for computing tax in case of listed shares or units of equity oriented fund or of business trust where STT is paid. Such cases fall under 112A. So for capital gains long term, there are two sections. 112, what we studied till now, all was 112, and there is a special section 112. Now coming to tax computation of short-term capital gain. Computing the income firstly and the tax. Now students, again in this, there are two parts. Other capital asset and section 111A. Now for other capital asset, it is treated as a regular income and regular tax rate like slab rate will apply. So if the short term is of any other capital asset, there is no special treatment for that short term. It will be treated as a regular income and the tax rate will be your regular tax rate, which may be slab rate in case of individual HUF. But the second possibility is it is covered under section 111A. What is covered under section 111A? Same thing. What is covered? Listed equity shares or units of equity oriented fund or business trust. Now, what you are selling is either listed equity shares or units of equity oriented fund, again on which STT is paid, but it is short term. It will be covered under 111A. If it is long term, it is covered under 112A. Here, nothing special. Sale price, expenses on transfer, STT paid is not allowed. So your net consideration is again sale price, and for cost of acquisition, actual purchase price. Short-term capital gain under 111A. Now, what is special? The tax rate of this capital gain is special. So let us say this capital gain is coming as 250. Now you'll be calculating tax. What rate, students? Tell me. So see, this is the computation. Triple 1A. What is covered? Same. Equity shares, units of business trust, units of equity oriented fund, and again STT is paid. Now here, the special tax rate is 20%. Now up to last year, it was 15. Now they have made it 20% on this 2,50,000. Please compare. Here, there was an exemption of 125. There is no exemption here. Entire 250 is taxed. So firstly, what is common is both 112A and 111A. Both sections cover the same thing. Same capital asset, that is listed equity shares, listed units of equity oriented fund or units of business trust on which STT is paid. But what is different is here there is no exemption, whereas here if the asset is long term, there is exemption of 125. Here the tax rate is 20%, there the tax rate is 12.5%. So students, this is what is the tax rates relating to capital gain And today we complete all provisions of capital gain. Only one 15-20 minutes part or maybe half an hour part is left. That is section 54 exemptions. That will take up in the next class when we meet for other sources, because maybe today it will be too heavy for everyone. But at least we have covered all provisions. That is the best part. Only now exemption is left. Fine. So we completed different computations under different possibilities, and all types of capital gain computation with indexation, without indexation, everything was done. So this, I'm sure, will be very helpful to you to understand entire capital gain provisions, right? Fine, students. Anybody having any questions? Students, any questions? No, beta. LTCG under 112A is taxed at 12.5. Sorry, if you're saying 112A, see, 112 and 112A are different. 112A tax is 12.5%, correct? 112, there was an option of with indexation, without indexation. Without indexation, it is 12.5. With indexation, is 20. Correct, Navneet? Fine. What you are saying, 20th and 21st. What is this, Beda Dhanalakshmi, from 20th and 21st? I didn't get, Beda. Some index calculation is applicable. Which 20th and 21st, Dhanalakshmi? Dhanalakshmi, which 20th and 21st you're talking about? So, Beda, why 20th and 21st indexation was applicable? Because in these two sums, we were taxing capital gain of earlier years, which was before 24-25, because 24-25, that is in the last year, in financial year 24-25, from 23rd July onwards, if any asset is transferred, indexation is removed. But if asset is transferred before that date, indexation is still applicable. So even if today you are doing calculation of any past year, indexation will still apply. Indexation will not apply only when you are doing capital gain of any period after 23rd of July 2024. Pranav, I'll explain that better. I can explain many things, but doing everything at once will be bombarding. Whatever you are able to understand, you will miss out everything. So I'm purposefully keeping things back. Don't worry. Anyways, that is what is part of tax computation. So whenever tax computation chapter will happen, that will again be discussed. But even since it is mentioned here, I'll cover that. But I'm purposefully better keeping things in parts so that it is digestible, right? Divya, better, it makes no difference whether what you are selling is very costly or it is very precious, so far as it is a personal effect and it is not fitting in the jewelry or work of art and those exceptions. Personal effects, however costly they are, will never be taxed. Fine, Divya, beta? Yes, Navneet, you can say so. Correct. You're right, Navneet. So this is in fact what we did in few sums. For indexed capital gain, we took 20% rate. For without indexation, we took 12.5, and that is where we compared to decide which one we should take finally, whichever is lower. Students, I'll request that please go back to the provisions, maybe go back to this recording, this and the previous recording, because that is where we discussed we did all the workings. Please go back. You still have time. We'll be meeting again in the next week.
Hello.
Time this weekend. Please go through them so that you will understand things properly. Correct? Yes. Any further questions, students? Anybody? No? So should we conclude today? But STT is not deducted. In capital gain, Aditya, STT deduction is not there. I've put a cross. You can see I've not deducted. I've written sale price only in net consideration. Why? Because STT is not deducted, Aditya. Kuldeep, it is slightly difficult directly to understand from Bare Act because, as you see, the sections in the Bare Act are not in a sequence that is required by us for solving. That is why I have created my those short notes where I have tried to put all provisions at one place so that at least for the purpose of solving, you will be able to understand. See, Bare Act is like in bits and pieces. It is like our Bhagavad Gita. There are different shlokas, but how one shlok of one section is connected with shlok of another section, that you will require a lot of time and lot of working to keep means understand that. So I'm showing you all barracks because I want you all to have the actual visualization of barracks also. But while explaining, we are following our module, which is in a more structured manner. And to further concise it, I have made my those tabular format notes, which I'll be sharing with you all. So that is the best way to study, right, beta? But definitely you should read barracks, but directly studying from barrack may be difficult at this stage. So you first refer our module, and after going through the module and the lectures, then you can refer that point in barrack. Then it will be more convenient for you to connect. Fine, beta? Okay, then students, let us conclude. Thank you very much. It was great time teaching you all capital gain. I enjoyed this whole topic. One small part we cover in the next class before we start with the next topic. Thank you all. Please go through this and the previous class lecture again on the recording, and also the workings. Please revise because otherwise everything will evaporate very fast. Good day. Take care. Bye bye. Yes, Manishji. Thank you, sir. Good day.